So, Lynn, do you see a time coming in the near future where we see a political shift back towards creating more fossil fuel production because of societal pressures of people not having enough energy? Or could this happen if the price of energy gets high enough to just incentivize those companies for a long enough time to invest in more capacity again?
So I think we see it in a jurisdiction by jurisdiction basis, and so a number of emerging markets have basically said, so we're shifting more towards energy security now, which is basically a polite way of saying we're going to do less CSG and we're going to make sure we get all the energy we need at all costs.
Mhm.
And so especially places like India and China, they basically said, look, if we have to build coal plants, we will, because that's less problematic than just not having electricity for people.
Mhm.
Um, and it's unfortunate because coal is one of the dirtiest sources of energy, but that's what they have in that region. Um, and so I think that we're already seeing it in a number of markets. I think we are starting to see some uptick in developed markets, where some of the politicians are not polling very well that have had these policies. And I think it's kind of this natural evolution over time where if people, if politicians do policies that the results of those start getting mark to market, right? So maybe in a cheap commodity environment, we didn't really see the ramifications of those policies, but now that we're in an expensive commodity environment, they're more apparent. And so if they are unable to solve those problems, they get voted out. They bring in another batch of politicians. We see if they can solve it. If they can't, they get voted out. It's usually multiple wrong answers until you get to the right answer. And I think that that's kind of the phase we're in, where you know we're going to have a lot of political turmoil until they start finding the right answer. And that's a process that can take years to change hearts and minds, as well as let technology catch up a little bit.
Mhm. So, what do you think about the possibility that we're on the edge of an energy cliff, where we're at the beginning of a time where the energy return on investment is falling rather dramatically?
So that's partially a choice, right? I mean, we humanity reached the highest level of energy density, energy return on investment, which would be nuclear, and we shied away from it over the past few decades. So we kind of we when we transitioned from biomass to coal to oil to natural gas to nuclear, we kept going up the chain of more and more energy return on investment. And it's kind of like we like Icarus, we flew too high, and then we just for whatever reason we just felt like we couldn't do it anymore, so we stepped back from that. And I think that if we decide to invest in 21st century nuclear, right? So the three major nuclear disasters, even though they happened in different decades, they were all 1960s and 70s technology. They were all built around that era.
Mhm.
And so there are 21st century technologies. One is that nuclear is already actually the cheapest, I mean, the safest form of energy, really, when you get down to it, um, even though the headlines don't always match that. But I think the 21st century technology can make that even better, right? So I think that when we're not using this older technology and we're actually maybe making smaller plants and other things like that, that can be further improved. But whether or not we go down there is another question. Um, and
And
so I
and
do I
and
do think yeah. Go ahead.
sorry, Lynn. I just wanted to add, and maybe taking out some of the human element of running those plants. I know a lot of the contributing factors to those disasters were human error, right?
Yeah, automation can improve that as well as the reactor type, and just have more R&D to figure out how to make better and better reactors.
Mhm.
And so I think that we don't have to be at the end of our energy density, kind of evolution. So I think that that's partially a human decision. I do think that we might be reaching the maximum amount of oil we can pull out of the ground in a given year. That doesn't mean that we're running out of oil, but it just means that our ability to keep having more and more oil produced per year might be getting towards the end of its cycle.
Mhm.
And so I actually do think that there are a number of challenges going forward about the ability to keep growing at the pace we have been, which is largely a result of energy. I mean, if you map human population, human lifespans, and things like that onto when we discovered fossil fuels and our energy production, it's pretty much the same chart. Basically, the past few hundred years, this whole industrial revolution really has been a result of us tapping into these dense energy sources. And I do think that going forward, that is going to be more challenging and less kind of easy than it has been for the past 200 years.
Mhm.
That's kind of a big picture view.
Mhm. So, as we think of the Fed's main tool of decreasing demand here, do you think that the or the main tool of fighting inflation is basically by decreasing demand. Do you think that commodities will have a material pullback because of this, or is there just not enough supply because of lack of investment for so long that prices need to remain high in most cases?
So I would be worried about some commodities in the autumn. I think once we get past maybe summer driving season, get past some China reopening, um, if they are still tightening and still trying to hold demand down, I do think you could get maybe a pullback or maybe like a like a stagnation, like it stops going up and those prices kind of chop sideways for a period of time. Um, the way I've described it is I think this can be an inflationary decade, but not necessarily in a straight line.
Mhm.
And just like I described before, even with Weimar, even the most inflationary periods, there are periods of attempted pushback, and so again, in a mild, like I'm not comparing this to Weimar, but in a milder sense, I think there will be periods of pushback, and so I think that looking back at the end of this decade, most commodity prices will be higher than they are now. But I do think that there are dangers of a handful of quarters in a row where you can have some pretty significant contractions or stagnations.
Mhm.
And I'd be on the lookout for that maybe in the second half of this year.
So you say that the easiest way to navigate an uncertain monetary environment for the long run is through diversification and rebalancing. So does this mean that most investors need to be more nimble now than ever?
Either nimble or more diversified. So I think, a lot of investors assume incorrectly that the 60/40 portfolio is diversified because they own, say, 500 companies and then they own treasuries. The
Mhm.
problem is that the vast majority of that asset mix benefits from disinflation and is hurt by inflation.
Mhm.
And so I think the way to improve that is to have some equities, have some cash or bonds, but then also have some commodity exposure. And that can take different forms. That could be commodity producers. That can, in addition to be having some gold or Bitcoin in your portfolio, kind of these harder monies, these things that don't increase in supply at nearly the same pace. And I think that that can, you know, add a ballast to the other parts of the portfolio that generally benefit from compounding and disinflation. I also think that history shows that in more inflationary decades, generally you get value outperformance compared to growth as a factor, and it's partially because the energy producers are generally in the value camp, commodity producers, right? So they're directly benefiting, but also usually when you have a regime change, right? So at the end of a very long disinflationary period, the stocks at the top of an index are very well adapted to that disinflationary environment, right?
Mhm.
So these overpriced growth stocks that are kind of based on low interest rates, and when that starts to reverse, a lot of the things that were not adapted to that environment are undervalued, like energy companies, and a lot of things that are well adapted to that are overpriced, like growth companies. And we start to get that reversal. That can take years to play out, where you're both getting a valuation contraction and weaker performance from the growth equities, and you're getting a valuation expansion as well as good underlying performance from the value side. And so I do think that again, there will be periods of reversal, but I do think that the value side of equities are a decent place to be this decade. So that includes energy producers, but also energy transporters that are less price sensitive for it, healthcare stocks, basically a lot of real world, low multiple, often dividend paying types of companies.
Mhm. Lynn, can you explain to our listeners if gold's stock to flow ratio makes it easier to manipulate?
It does because so if you have a low stock to flow ratio, like let's say oil, there's only so much storage in the world, and most of the output gets consumed as quickly as it's produced. And so there's no way to fake. I mean, my car is not going to run on paper claims for oil. I need the actual gasoline,
Mhm.
right? Um, Whereas gold, a lot of investors are fine having basically a paper claim for gold. They don't need to consume gold. They don't need to consume physical gold. And so when you have something with a high stock to flow ratio where you consume a lot less of it than the amount it exists, it is easier to have basically a large paper market, a large derivatives market based around that existing large storage amount. So you can have more claims for gold than there is gold. And as long as the majority of investors are fine with that arrangement, that can last for quite a long time. Now, every once in a while, that kind of breaks, like you saw the failure of the London gold pool in the 60s, right? That system is not bulletproof, But yes, in general, high stock to flow ratio commodities are, easier to manipulate. Now,
Mhm.
there are other factors like how easy is it to self custody, right? So if anyone tried to self custody large amounts of gold, it's obviously very challenging. It has challenges with portability, challenges with security, and that's why historically it got centralized in the first place, and that many people are just happy to have a derivative of gold rather than gold directly. So stock to flow ratio is not the only factor, but it's certainly one of the factors that can make it easier or harder to manipulate a certain commodity.
Mhm. So, Lynn, do you prefer, or let's say, are there times where you prefer having derivatives of some of these commodities or metals, let's say by owning miners versus the physical commodity of gold, let's say, rather than other times?
I think it depends on the specific purpose you're going for. So I mean I think that self-custodied gold, silver, Bitcoin, things like that have a use because they're outside the financial system. You self-custody them. I think they're important. Now, if you want additional price exposure above and beyond the amount that you're willing to self-custody, that's where some of the derivatives can come in handy. And then also, the companies can provide some operational leverage on top of that. So, for example, if you expect a large increase in the price, something where they have fixed debt, they have fixed costs, but then they have variable upside, they can potentially do better than the underlying metal. Now, the challenge also is it depends on your view on what happens with energy. So, for example, if you expect gold to do well and energy not to do very well, then the miners would be very attractive places to be because their expenses are going to be relatively contained while their revenue is increasing.
Mhm.
On the other hand, if you think that energy is going to go up as fast or faster than gold, you might be more cautious about the miners, and you might want to either hold the underlying or you might want to look into the streaming and royalty companies that have most of that upside without really the variable expenses. And so it partially depends on someone's specific view on both the metal and the expense side on their best way to play it. And so I think that, obviously having physical gold in your possession is going to be a different risk and reward profile than having exposure to mining equities.
Mhm.
So it really depends on what someone's trying to do with their view, and with their reason for owning that in the first place.
Mhm. Excellent, Lynn. Well, I think that's a pretty good place to wrap up today's conversation. Is there anything else you'd like to add or touch on before we do?
No, I think that covers it. I think that we're in this transition period where we have the first declining PMI cycle with rising inflation in modern history. We'd have to go back decades to find another one of those events. And so a lot of back tests over 20, 30 years are not going to be very informative for this type of environment. That's a challenging thing. You have to go back kind of longer to find similar periods. And I think it requires a degree of humility and data dependency, because this is a very challenging environment. So everything's about probability assessment rather than certainty. And so I
Mhm.
think that's how I approach things going forward.
And of course, I really urge our listeners to head over to your website, lynalden.com. And, for example, just read your newsletters. Your previous May newsletter has a lot of the issues that we talked about around inflation. You said you have to be very data dependent and very data heavy, and you do an excellent job of helping make sense of all that data. So I urge our listeners, if they have any interest, to go check out your website, lynalden.com. And of course, you're available on Twitter at Lyn Alden as well, right?
Yep, I appreciate that.
Excellent. Thanks so much for your time today, Lynn. Really appreciate it.
Me too.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.